You're checking your portfolio again. Maybe it's up 8% this year, maybe down 12%. Either way, you're watching billionaires somehow pull 20%, 30%, even 50% returns while you're stuck with index funds and hoping for the best. Here's what nobody tells you: your approach isn't wrong, it's just catastrophically incomplete. I've spent years tracking what the smart money actually does, and the first pattern blew my mind. When I analyzed the portfolios of the top 15 wealthy investors, Amazon appeared in 9 out of 15 portfolios. That's 60% of billionaires betting on the same stock. Meta shows up in 8 portfolios, Google in 7, Microsoft in 7. These aren't small positions either, we're talking about massive allocations that would make most financial advisors nervous. While you're being told to diversify across 20 different sectors, the ultra-wealthy are concentrating their bets on the companies they know will dominate the next decade. But here's where it gets interesting: the second pattern completely contradicts everything you've been taught about risk. Take Carl Icahn's approach with IEP. It appears in 7 out of 15 top portfolios, but here's the kicker: these investors aren't just buying a few shares and calling it diversification. They're making massive, concentrated bets that would give most people heart attacks. While traditional advice tells you never to put more than 5% in any single stock, these billionaires are regularly putting 20%, 30%, even 40% of their wealth into their highest conviction plays. Broadcom shows up in 6 portfolios, Nvidia in 6, and these aren't token positions, they're life-changing money on companies these investors truly understand. The math is simple: if you're right about a 10 times winner but only put 2% of your money in it, you've barely moved the needle on your wealth. But that's not even the most surprising part of how they think about winners. Here's where most people get it wrong: they chase the flashy IPOs and meme stocks while billionaires are quietly loading up on companies that have been winning for decades. Microsoft, Google, Amazon, these aren't sexy startup bets anymore. They're mature, cash-generating machines that most retail investors think have already had their run. But when you see Micron Technology in 5 top portfolios or Uber in 5 portfolios, you realize something profound: the wealthy aren't trying to find the next big thing, they're buying the current big things at reasonable prices. They understand something most people miss: a company that grows earnings 15% per year for 10 years will absolutely destroy your returns, even if the stock seems expensive today. And the fourth pattern? It's going to challenge everything you think you know about playing it safe. This is counterintuitive, but bear with me. While you're being told to own 500 stocks through index funds, billionaires are doing the opposite: they're concentrating on maybe 10 to 15 companies they know inside and out. Warren Buffett famously said diversification is protection against ignorance, and the data backs this up. When you see the same names, Amazon, Meta, Google, Microsoft, appearing across multiple billionaire portfolios, you're witnessing something powerful: informed concentration. These investors spend months, sometimes years, studying a single company before making a move. They know the management teams personally, understand the competitive moats, and can predict earnings better than Wall Street analysts. By concentrating their bets on their highest conviction ideas, they're actually reducing their risk because they're investing in what they know, not what some index committee decided to include. The final pattern might be the most important one for your own portfolio. Here's what separates billionaire investors from everyone else: time horizon. When you see these same tech giants appearing across multiple portfolios year after year, you're seeing patient capital at work. They're not checking stock prices daily or panic selling during market corrections. Google's parent company appears in 7 portfolios because these investors believe in the 10-year story, not the 10-day chart. They understand that Amazon's dominance in cloud computing and e-commerce isn't going anywhere, regardless of what happens to the stock price next month. This long-term thinking allows them to ride out volatility that would shake out most investors, and it's why they can afford to make concentrated bets. They know they won't need the money next year. Now that you understand how the wealthy actually invest, let me show you exactly how to apply these insights to your own portfolio, even if you're starting with just a few $1,000s. Here's your action plan for this week. First, Pick 3 to 5 companies from that list and spend serious time studying them. Read their annual reports, understand their business models, know their competitive advantages. Second, consider concentrating your investments instead of over-diversifying. If you truly believe in a company, a 2% position won't change your life. Third, extend your time horizon. Start thinking in 5 to 10-year periods instead of quarters. And finally, focus on companies with sustainable competitive advantages, not just hot momentum stocks. The wealthy didn't get there by following conventional wisdom, and neither will you. If you want our advanced analysis on which of these billionaire picks offer the best opportunities right now, check out nexusaicalls.com.